We've referred to you all morning. A 6 o'clock guest would be diametrically opposed to you. What we've got here is, of course, what you're saying. A glacial Fed, a terminal rate of 1%. This is a very dovish view of where the Fed ends up in 2017 versus what Evans has said last night.
It is. I mean, certainly when you look at those comments, they're at the more ambitious scale from Evans in terms of potential rate increases. Take a step back, look at just the trajectory of data. It doesn't suggest that at the moment for both growth or inflation. The other key, and your chart is brilliant at emphasising this, is, of course, the dollar. The dollar's doing the Fed's work for it. So as you get a stronger dollar, it tightens financial conditions. That, of course, means that the Fed need to do a lot less in the form of actual rate hikes.
So, but you don't. How much stronger do you think the dollar is going to get? Because you don't think rates will go much higher. But you don't think the dollar is going to strengthen that much.
No, the dollar's sort of done now because there's a natural tension there. As you get the dollar strengthening relative to other currencies, it tightens policy. You don't want too much of that. So there's a limit and there's a cap on how strong the dollar goes. So this move we've seen in the dollar now is about done.
That very naturally, just as I listened to you say that, don't worry, I'm not going to pull up the 3D of the bond curve. That very nice. No, go on. GC 3D. That brings me to equities. If what you've said and the dollar is less of an obstacle, then presumably, are you upping your weight on US equities?
Again, what equities don't want is this big snap higher in terms of the Fed funds rate.
Yes.
And when you look at it, the reality is they've not really gone anywhere lately. So it's really a holding pattern for equities. The other side of that, though, is there's much more juice in things like high yield, where you're getting equity-like returns, if not higher returns than equity, for actually a lot less in the way of volatility.
So all of those people call them tourists, bond investors who are in the stock market, looking in utilities and other higher yielding sectors for sort of bond-like returns, bond proxies. You think that continues then? Because a few guests say to us that trade looks really overdone, that trade looks in danger of snapping back. Be careful there. But from what you've said, if you think yields are staying low on treasuries, you think that continues?
On a relative basis, they look good because we're in a world where income and yield is prioritised. That's one form of it. The other form of it is things like high-yield bonds. Increasingly, it will also be things like emerging market debt. Now, that seems an odd thing to say, but if you've got a stable dollar out there, it means that for emerging market local currency, so Brazilian bonds in Brazilian real or Mexican bonds in Mexican peso, you get quite a high yield, and it's pretty stable because their currencies are stable relative to the dollar.
The other two major bond markets that we should focus on is, of course, the JGB market, which now has a new target, the target of 0% on the 10-year portion of the curve. Will they be successful? Where do JGBs fit into your thinking?
It's tricky to see actually how the Bank of Japan managed to get that 10-year yield at a yield of 0. I mean, since they've announced that policy, 10-year yields have never, ever been at 0. They've always been beneath 0. So how do they do it is the real question markets have.
Taper?
They could taper, but at the same time, they've committed to increase the size of the monetary base because, of course, they want to increase inflation. So if they taper 10-year purchases, they've got to buy a lot more in terms of very front-end bonds. The difficulty there is they already own 50–60% of short-dated JGBs. So the devil there is in the detail of the practicalities of the yield curve control concept.